we are targeting investors that stay with us and they get a double dip, right? They make their money real quick on the horizontal. And if they stay in, then they also get to enjoy the lucrative benefits of staying until the vertical is completed. But we don't force people to stay in. If they just want the higher returns in that middle phase, we allow them to get out.
Okay, for today's matchup, we're super excited to have two burgeoning champions of syndication investing. These gents are both specializing and thriving in areas on the active side of general partnerships and commercial real estate investing, and they both also work with passive investors. In this episode, we're uncovering what it takes to get started, taking an active role in the partnership, and what kind of ROI you can expect to make leveraging your sweat equity. So let's get to it. Fighting out of Denver, Colorado, where he lives with his wife of 10 years and their young son, this cash flow creator has worked in the healthcare field for over 10 years. He's on a mission to help others build wealth through the power of rental property acquisitions, purchasing undervalued assets, driving improvements to those properties, communities, and generating cash flow for investors. He's a partner in over 300 rental units, is also working on an investment fund focused on short-term rentals, and is always on the lookout for risk-adjusted opportunities to fuel his investors' dreams. Representing cash flow creation through the investment of rental properties, please welcome Jesse, the investor with a heartbeat, Dickens.
Woo! Hey, thanks for having me, guys, and thanks for that awesome intro.
You betcha, man. All right, fighting out of Phoenix, Arizona, this cash flow crusader has fought his way through various disciplines in the real estate market since 2005. He cut his teeth on multifamily value-add deals and syndications since 2019. He's also the host of the Capital Raiser Show podcast, a thought leadership platform on a mission to help other syndicators scale up and fund their real estate deals. He's currently a partner in multifamily and residential rental units in Arizona, having gone full cycle on a larger property as well. Representing the build-to-rent investment model, he's currently in the process of deploying 475 build-to-rent houses across 3 different subdivisions. Please welcome to the Cash Flow Fight Club arena, Ruben, the build-to-rent bruiser, Greth.
Yes. What a fantastic intro. Really good to be here, Mike and Lygia. Thank you so much. Jesse, can't wait to get into it.
Yeah.
Yeah, you guys, we're here just to have a little fun, really, but we're honored to have you both. Looking forward to digging into your business models. And as a quick reminder, we'll do 3 rounds. Round 1's really about getting to know you guys personally and what brought you to where you are today. Round 2, we'll dig into your business models. And round 3, we'll dig a little deeper and try to decide here who is the title of Cash Flow Fight Club champion.
Well, let's kick off round 1 with Ruben. Ruben, tell us a little bit about your journey into real estate. What steered you into this journey and how this transition impacted your life?
Yeah. When I was young, my dad was a single family investor. He passed when I was 7 years old, but that seed was planted. And after graduating college, I was like, I need to get into real estate investing. So I thought a good stepping stone would be mortgages. Found out relatively quick that didn't help me too much when it came to investing. But I did start a real estate club here in Phoenix, and the meetup attracted some people, including a fourplex buyer who showed up in town in 08, 09, right at the bottom of the market. He had gone bankrupt, lost all his money in spec homes in San Diego, but was purchasing a fourplex like every other week. So I was like, how are you doing this? Coming from the bank, I didn't believe that he could be financing them. So he introduced me to this concept of raising capital. And I'm like, really? Let me follow you around to your projects and shoot some videos of you. I'll do some marketing for you. Maybe we can create some new partnerships with people that I expose you to. And sure enough, I raised about $600,000 over a matter of a year. We bought a bunch of units, a lot of fourplexes that were on sale, like a fire sale during 09 and 2010. And they were cash flowing astronomically. And I really thought that I had arrived in real estate, but I didn't anticipate the problems of being a partner. So we broke up, and then I left real estate altogether, made money on all my fourplexes, and I tried to find my way back about 5 or 6 years later. And I was like, all I know is fourplexes. So I came up with this plan to buy a bunch of fourplexes, and somebody was just like, how many of these do you want? I'm like, 32 fourplexes. They're like 128 units. Okay. Why don't you just take them all down right now? And I was like, what? I don't know how to do that. It doesn't even make sense to me. So they introduced me to syndication. And then I teamed up with some local syndicators, launched the Capital Raiser Show so I could learn how to raise capital effectively and compliantly from limited partners, and then opened up an entire universe that I didn't know existed, including raising money from funds and family offices and institutions and creative finance. So I was like, all right, I'm going to go launch a fund so I can have access to all these sponsors deals across the country. And that's when I came across Andy McMullen, who introduced me to build to rent. And so we've been diving pretty deep into that space and doubling down. So now we're raising for our own deals instead of for other syndicators. And it's been a crazy journey, learning the whole development side and raising capital for a unique niche of real estate. So that's how I got here. It's been a fun ride.
That's pretty cool. So, I mean, you got the bug, it sounds like, early from Dad, and then just have followed a path to where you are here. Sounds like you had a brief respite outside of real estate industry, but found your way back in. So good stuff.
It was blessed.
How about you, Jesse? Give us a little bit of insight into your background, your journey until now, and how do you balance your W-2 with real estate, family life?
Sure. Imbalance is I feel like it's kind of an illusion. We strive for imbalance, and I feel like it's you find ways to be okay with the imbalance of your life more than trying to strive for that, to create this illusion of balance. But I come from the medical field as far as my W-2. I do cardiac sonography. I graduated in 2016. We bought our first home in 2016, and that process of buying our own single family home just completely changed the direction of my life, because I fell in love with the process of real estate. And I had no idea what it was going to look like, but I made a decision right then and there that I wanted to do real estate in some kind of capacity. And sure enough, shortly after that, I picked up the book, Rich Dad Poor Dad, the Purple Bible for us. I'm sure
I've not heard of that one. Is that?
It's new. It just came out. You should check it out. It's pre-released. And that absolutely, it made me angry that in my 30s, this was the first time I was hearing and learning about these concepts. And I called my parents up and I said, why didn't you guys teach me anything about this? And they had no idea. And I really started looking into the idea of building streams of income as opposed to building a career and relying on a source of income from a W-2 job. And it's funny that you talked about balance, because ultimately I love what I do and I don't want to necessarily stop doing that, but I don't want to rely on that to pay my mortgage, put food on the table for my family. So that was kind of the preemptive journey to get into real estate. I jumped right into, I did a couple fix and flips, realized that's not me. I'm not a contractor. I don't wear a tool belt. And I had a lot of sleepless nights doing that. So I realized that multifamily was the direction I wanted to go, and I wanted to build those long-term passive streams of income, joined a mentorship program, and jumped right in. We've purchased 3 properties on our own down in Arizona, not too far from Ruben, just a little bit farther south down in Tucson. We've done a co-GP deal and really teamed up with a large-scale operator on a project out in Greenville, South Carolina. We're looking at some properties locally here in Colorado, and also have started up a fund to raise capital for some short-term rentals. So it's been a little bit of a diverse background in what we've gotten into, but really multifamily is the driving force, and a little bit of short-term rentals on the side.
That's great. So something that piqued my interest, your first home buying experience somehow piqued your interest in real estate. Like, I can tell you, my first home buying experience was not a pleasant one. So I don't know how that would make anybody want to go into real estate, but I'm curious what that trigger was.
Yeah, I don't know. It was the first time I'd never been on Zillow looking around at different properties. And I think it was just the idea. It's such an emotional decision of thinking about where are you going to raise a family, and researching different school districts, and it just lit up this piece of me that I didn't even know existed. And I just
having an asset and just all of that. Yeah, I can see that.
So and it was just fun going and touring properties. And we had a great real estate agent, and just absolutely loved the process.
Yeah, that part is great. Maybe the part Ruben started out in, the mortgage piece of it sometimes can be stressful and just a lot of moving parts. It feels like, especially for that first time.
Yeah,
not quite there. Cool. All right. Well, let's jump into round two here. So let's talk about your business models. Jesse, maybe we continue with you. Just get into a little bit about small multifamily, how you've gone about it. It sounds like you joined a mentorship group, which is great. Highly recommended to anybody that's getting into commercial assets, at least, or bigger ones. But what's that been like, and how do you go about finding your deals?
Sure. You hear a lot about the term value add multifamily real estate investing, and what our approach is no different from that of many others. We look for underperforming assets, whether that's through deferred maintenance, unrenovated units, mismanagement, or a lack of proper property management, and come in and just offer those solutions to really drive up the net operating income. So we're trying to lower expenses, drive income up higher, and create a new valuation based on that. Obviously, commercial properties are based on their net operating income rather than comparable sales. So that gives us the flexibility that once that process has been done, or at least part of that process, and we're sitting on an equity position, you can either just ride the property out and cash flow it. You can refinance it. Right now, refinancing does not make any sense for the most part. Depending on when you got your debt and what those debt terms look like. But, debt is the very challenging piece that all asset classes are struggling with at the moment. Or you can sell and take your gains and try to defer them through a 1031. But it's really, the whole model is based on value creation, based on executing your business plan of really driving the value. So that's why we are so drawn to it. We like the small and mid-sized multifamily. So when I say small to mid-size, we're talking about in the 10 to 30 unit range is really where we have played. Mm-hmm. We think that range really goes up to more like 50 units, depending on the market, because there's this sweet spot where you're not dealing with the super mom and pop investors of someone that is trying to buy their first duplex or maybe a fourplex. And you're not dealing with institutional capital on the higher end of 100 unit plus property. So you've got this sweet spot where there's less competition, but there's still a lot of mom and pop owners with that have a lot of quote unquote meat on the bone for you to come in and execute on your business plan. So that's the model that we have really fallen in love with. And we think that it really works. The market cycle that we're in right now is very different than it was 2 years ago. And we think that this idea of creating value works regardless of what cycle you're in. So that's a brief synopsis of our model.
Yeah, that's great. Thank you. When you're looking for your underperforming assets, is that are you guys just digging through the pro forma and doing your underwriting analysis on properties that you know of that are for sale, or are you proactively looking at in some other way to find off market deals, or how are you going about finding your deals?
We've done a combination of both. Our first deal was off market. We landed it from cold calling and direct mail marketing, and sending out postcards. And we found an owner of a 24 unit property that had it for well over a decade. And he was the owner. He was the manager himself. He walked around on the first of each month and collected checks and envelopes full of cash, like the ultimate mom and pop owner.
Yeah.
Rents were probably 30% below market. It was 100% occupied, so we got good financing on it. And he had horrible experiences with brokers in the past, and he refused to take it to a broker. So he was really excited that he got our mailer and really wanted to do an off-market transaction. So we've done that. Those are kind of harder to land, and we'll still do that periodically, but a lot of it now, since we closed that deal, our broker relationships have really formalized because of that. These are brokers that wouldn't take us seriously at first. They
Sure.
wouldn't call us back. And then we close on a property and then our phone starts ringing. So it's funny how that dynamic kind of changes, but they want to see that you are a closer. So now we've closed a couple properties with brokers in that same market. And some of those have been off market. It's before they've actually brought it to market. But it is their listing.
Yeah. That it really is. Once you prove that you are serious, you can close a deal. Definitely your relations solidify with brokers. It's also a lot to do with the market. I know it's totally flipped from when we started in 2019, I guess. And, you were chasing brokers and they're very friendly, but, they will talk to you. But then all of a sudden, the last 12 to 18 months, or maybe more in the last 12 months, I would say, the shift has happened to where, my phone rings as well with a lot of brokers, just shaking the trees, trying to work deals. Things have dried up, but now is the moment to really form those broker relationships, because they are very receptive. They're really out there trying to work for their clients, just because the market has slowed down. But it's an opportune time for anybody looking to get in to start to make those relations. But yeah, for sure, once you close a deal, then there's a level of seriousness that comes along with that.
Yeah.
Good stuff. All right, Ruben, how about you, man? On the build to rent side, give us some insight into what that's all about.
Yeah, I wish I could tell you that I do all of it, right? Like that I'm the guy that does financing, the acquisitions, the building, that I know the thickness of the shingles on the roof, but I stay in my lane, right? So I'm mostly focused on providing equity, managing our marketing division and our co-GPs and investor relations. So I kind of stay in my lane, but I've understood enough about our business model to be able to explain what we're doing and why we're doing it. So a lot of people start with like, why are you investing in Louisiana? And the reason for it is because that's where our builders and our friends and our partners live. And they are very good. It's essentially two dudes, one guy that had built 200 houses and his best friend from high school who worked for an institution and acquired about $750 million worth of land for different groups. And he wanted to no longer provide land for institutions and become his own syndicator. So him and his best friend partnered up and they started acquiring land and building houses on them, but they didn't know how to raise capital. So they came to us through a couple of networking meetings and they're like, hey, we found this very lucrative model. We make a lot of money building houses, but we still need a capital infusion. So we looked and underwrote their business model and said, this is pretty lucrative. So we raised for a subdivision. And then what's been happening in the process is I've been kind of watching these builders manage their contractors, deal with all of the land and zoning and variance and changes and surveys and wetland and the whole architecture and everything that they do, and kind of explaining this to some people. We put a sewage plant, utilities in, and we're about to put in the streets and the utilities on a 100-unit subdivision, which should start actually building the vertical houses in about a month or two, in October of 2023. So we've been watching this whole thing happen. And in the process, we've also acquired 2 additional pieces of land. A lot of times our business model is we put an option to buy on a piece of land, and then we go and check with the city to make sure that we can get all of the zoning and permits and everything required in order to improve and force appreciation on that land. And once we determine that the answer is yes, we exercise our option to purchase the land. At that point, we go through a couple of phases of capital raising. First is for the horizontal, where we're putting in the street, sewers, utilities, sidewalks, etc. And then we do an additional phase of capital raise for the vertical, which is the least risky part and most risk mitigated part for the syndication, because a lot of the objection is like, I don't understand development. It's a long process. So when we can remove all of that risk, we bring in people, and essentially the limited partners and the co-GPs and their databases of people, we can double their money within a period of, we say 5 years, although internally we believe we can build from the time that we syndicate to the time that those houses are done in about 24 months, and then sell the property in about 30 months. So we're essentially doubling people's money in these 506c syndications for accredited investors only within about a 30-month period, even though we're underwriting it with all kinds of contingencies, so that we, explain to them, we can basically double your money in 5 years, and then we overperform on that. And it's a very fun model. So it's very lucrative for the co-GP, for the LP, for the general partners, and the general contractors. So everybody is participating, making a lot of money while we're creating impact in the community, creating jobs and beautiful housing with amenities for people to, if they're tired of living in an apartment where they have someone above them, below them, to the left of them, to the right of them, with a tiny little balcony, and they want that home experience, right, where they have a doggy door and a backyard and a driveway and that space in between the residences, they come to us, as particularly in this market where a lot of people are not buying because the rates have been going up and their buying power has been going down, and they're kind of waiting, thinking, well, maybe the rates will go down, and why would I buy a house now if I can wait 6 months? But they're finding out that the rates just keep on going up, and it's getting harder and harder to qualify for a home. So if they want that home experience, one of the things that we love about Build to Rent is they can come to one of our places and they end up staying there because of the community, the amenities, and the fact that they have all this privacy and they can consider it a home. And they actually default less than any other category in multifamily. So it's just, from a lot of perspectives, it makes a lot of sense. And there's a huge shortage of housing, of course, as everybody knows. So we're trying to solve some of that problem. It's a really cool business model. And I think that's the trend because of the fact that it's so hard to qualify and it's becoming a renter's nation.
Yeah, for all the reasons you just mentioned, there is a lot of upward pressure on rents and getting more affordable housing in both ways, in the affordable category, but then just housing that is affordable. But how are you guys? Are you then property managing a subdivision, or is you contracting that out to other outfits, or?
So we don't have a property management vertically integrated in our business, but that is a good question, because a lot of people that want to own single family homes, they don't want to have a big portfolio of them, especially if they're single scattered sites, because they're so hard to property manage. The nice thing about build to rent subdivisions is you have all these individually unique parcel properties all in one place with one property manager and one leasing agent. And it's valued, the entire thing is valued like a commercial real estate asset, just like multifamily, where it's based off of the net operating income. And then once we build these things, we rent them out as we're building them. And by the time we're stabilized at 90% occupancy, we sell the entire subdivision off as one commercial asset to an institution. But there are multiple exit strategies that you can sell a couple houses at a time, 10 houses. And then there's multiple places where you can exit at the land phase, at the horizontal phase, at the vertical phase, in the middle of the vertical phase. You can keep it. You can keep some of it. You can sell the entire thing off. You can sell them individually with a broker. That sounds like a headache to me, though. 220 individual escrows is just kind of like brain damage. So we sell the entire subdivision off to one institutional buyer, and that's our business model.
I was about to ask you if you guys offer rent to own, but it probably doesn't make sense to.
So rent to own is a very beautiful, creative finance strategy right now. And I think a lot of people that are having a hard time qualifying would benefit from that. And as a seller, the beautiful thing is that would be a potential exit strategy where we could turn ourselves into a bank. We wouldn't have the capital gains from selling the property in one big lump sum. And then we would receive cash flow from like as a bank, except we wouldn't own the property. And then if we ever defaulted on those payments, we could just take the property back and reseller finance it to another person. So that is a potential exit strategy that would be amazing, because obviously banks are some of the most lucrative businesses in the country. And when you seller finance, it makes you very profitable because you're capitalizing on all that interest along the way.
Ruben, can I ask you a question on the capital raising side of things? So you've got these different tranches that you're raising in. You're raising before breaking ground, and then you're doing it after all the entitlements. What's kind of the spread that you offer your investors that come in initially who are taking a little higher risk and to get that higher reward? What's the difference that you offer those investors from the ones that want to wait until, everything's entitled and ready to go?
Yeah. So at each phase of construction, there's a different risk profile. We typically purchase the land with our own money, so we're not raising at that phase. But definitely at the horizontal phase, we're offering more money and providing different structures for people to invest in, whether they want, because land and dirt does not cash flow until there's a property on there. So if people are seeking cash flow, we can offer them some kind of a unique structure where they get money through a personal guaranteed loan or something else. And then we can use that money to fund the equity portion of our build out. For the people that do want to invest and get that back end equity spread, which is really a lot higher than if you buy a existing asset, then what we do is we offer them a little bit more. I think it's like between 2.2 and 2.6% equity multiple, like within a very short period of time, just until we get the horizontal across the finish line. So let's say that we need to get horizontal built out and it takes 12 months, we can double people's money in just that time frame, which is very powerful for some people, but it's also riskier. So you get a lot more gain, but you have to go through the greater risk. And then once we're ready to go vertical, then we just treat it like a regular syndication. It's got similar, except slightly better returns than what we see as an industry average in the multifamily value add space. Nice.
So for a typical investor coming into your projects, Ruben, are you then signing them up under different tranches, like Jesse was saying? Like if I was coming in with $100K, could I invest just in the early build phase, or is everybody kind of signing up and locking in?
If you come in for horizontal, we are targeting investors that stay with us and they get a double dip, right? They make their money real quick on the horizontal, and if they stay in, then they also get to enjoy the lucrative benefits of staying until the vertical is completed. But we don't force people to stay in. If they just want the higher returns in that middle phase, we allow them to get out.
Mm-hmm. Interesting. Okay, so really flexible then in terms of that. It seems like. And so you mentioned doubling investors' money under different time periods, but what are on average the different ROI profiles across the investment?
They're like anywhere from 17 to 22%. It just depends on the deal, the location, what we're doing, how much of the risk we've already mitigated, at what time frame they're coming in. So it changes, which is kind of like one of the big variables when you compare it to multifamily. Everything is very stable, but in the development kind of syndication space, you have all kinds of things that can change and variables, like the price of lumber may go up or down in the middle of construction, and the supply chain may change, or the price of concrete may change, and the banks may come at you and say, hey, we need more reserves, and because this changed. And if you don't have the right contingencies, then you have to go out and raise more capital to meet the reserves that the banks have just changed on you. And a lot of investors, they don't like that, right? So they have to be able to be flexible. Builders in general have to be able to be prepared for all kinds of things that come up. Like if you're digging on a piece of land and they do a soil sample and a bone pops up, all of a sudden you got to do archaeological studies, right? So it's kind of crazy to deal with all the things that most multifamily value add or people that are buying existing assets don't have to deal with. So that's kind of like the frustrating part for some limited partners, but that's why they get paid a little bit higher return than they would if they just did a existing asset syndication.
Yep, makes sense.
And what about on this horizontal phase? I'm super curious just because I've never really broken down the BTR space. So like for the horizontal phase, obviously on a traditional syndication, or for you from on the development phase of it, so then an investor is going to come in right before building it out, and then they're going to get paid on the sale. And in the pre-existing, it's going to be the same thing. You're going to purchase it, rehab it, and the profit's going to come from the sale. So where does that doubling of your capital come from on the horizontal phase? Can you just offer that kind of preferred return? Or is that like a set in stone, hey, you're going to double your money, it's just a matter of how long? Or
So it depends on how easy it is to raise the capital for you, but you can incentivize people to invest with you during that horizontal phase because they know a lot of times that horizontal phase is going to happen relatively quickly. So they can get in and out within a year's period of time in a lot of cases. In some of our deals, we've been able to say, hey, we're going to be ready to go vertical and syndicate the rest in about 6 months. And we're still offering you to double your money or to do something very lucrative in that space just to get the money in so that we can complete our project. Because sometimes if you're stuck, you might have to sell the land, which is also an exit option. So you can have a base hit instead of a home run. But, it just depends on a lot of things. So I would say, you can double your money relatively quickly depending on which phase you come in, even if you come in at the very beginning. I guess at some point in the future, we're going to be raising capital for the land part too, or maybe have a hybrid fund where people get a mixed rate blend of all of the different risk profiles as long as they stay in through the duration. So we'll see how that works out. But right now we're doing it in phases. Hopefully that answers your question.
Yeah, it does. Thank you.
Let's flip over to you, Jesse. Talk a little bit about your ROI profile and what you guys see in your smaller multifamily deals or small to mid.
We guarantee quadrupling our investors' money in a 30-day time period.
Wow. Okay.
I'm in, Jesse.
Venmo me at.
So our return profile, we also look at that 2x equity multiple. We really target 95 to 100% of a return on your capital. Ours is typically over that 5-year time horizon. Obviously, the phase that we went through in real estate over the past 3 to 5 years prior to the last, I'd say 12 months or so, was really a turn and burn model where, as COVID was going on and rates were continually tanking and vacancies were just shrinking and rents were skyrocketing, that was happening in more of that 12, 18, 24 month period where it was a great time period. It was very much unsustainable, and that's not normal. And we're kind of back to a normal real estate fundamentals time period, which is great, especially on the buy side. But we always plan for that 5. We tell our investors, look for a 5-year time period, and we want to have our debt flexible to where if we, depending on where we're at that 5-year time period, if we need to extend a little bit longer, obviously, if we can match those returns, hit those returns in a shorter time period, we're willing to do so. But we're always looking for that 2x multiplier. That's a combination of cash flow and the sale proceeds. I think that's going to be one of the big differences here between BTR and pre-existing multifamily is just the time period where the cash flow takes place. So a lot of times in a syndication, ours is no different. We're looking at anywhere from the 6 to 8% average cash on cash over the life of the hold. The first year is usually quite a bit lower as we're in the process of restabilizing that property, and then usually around 60, 65, maybe even 70% of the profit is going to come from the sale. And we never underwrite planning on a refinance, but that's always kind of in the back pocket kind of thing, especially right now where the general consensus is this thought that rates will come down at some point over the next 12, 24 months. We're not sure when that's going to happen. We're not sure how much that's going to happen. So I think the big thing for us is having flexibility in our debt and being able to refinance with low or no prepayment penalties whenever we think it's the best thing to return some of our capital to our investors, take chips off the table, increase your return, get that velocity of money continually moving, but never be forced to do that. That's one thing that scares me. If I ever look at a pro forma deck and see a planned refinance, that is an automatic red flag for me. It doesn't mean that I wouldn't look at that deal any further. I would want to ask a lot of questions around that, but we always want to make sure that it's going to work on a traditional, say, 5-year hold, and then have that refinance, as we're only going to pull that card out if that's going to juice the returns even more.
Yeah, I think in those cases, it really depends on the acquisition debt that you get and what the terms are. There's interest-only periods. How long is that going to be? There's obviously, especially with value add, there's at least per the business plan, a planned increase in the valuation over the first 24 months or so, let's say. So, in a lot of cases, it does make sense, especially, like you said, now where hopefully rates have peaked or are very close to peaking. And even if they stay flat over the next couple of years, then, just pulling value out of a deal might make sense if there's not burdensome fees or anything like that.
Yeah.
I did want to circle back, Ruben, on yours and talk about cash on cash and how that plays out, if that's even part of build to rent type deals, or if it's really just a total return and or maybe some equity events in between.
Yeah, it's a little bit different because you're investing in dirt, right? So you're not cash flowing right off the gate, which is right. How you base cash on cash. What an interesting thing that we haven't really covered is that you're forcing appreciation at every step along the way. So like on a typical $30 million multifamily value add, for example, you may have to raise 30% of it so that you can qualify for financing, and then another $3 to $5 million to rehab the units and get it up to par so that you can increase the rents and the net operating income. So you might be looking at a 12 to 14 or $15 million raise for a $30 million project that you buy. Whereas with a build to rent, for a $30 million build to rent subdivision, you may put down $1 million, buy some land, put down another $1 million to qualify for a $3 million loan. And then after you put in horizontal, the $5 million that you have into it, the 1 million plus the 1 million plus the $3 million loan may actually be worth 9 million. So you're already at 30% loan to value or 30% equity in the deal. And as you refinance out, you might only have to do a $9 million capital raise versus a $14 million capital raise for a brand new project. So at every single little step along the way, you're forcing appreciation, which, that is the name of the game, right? For most multifamily guys, they force appreciation through net operating income, but we actually have the ability in build to rent and development to force appreciation at every little step along the way. When we entitle it, when we add utilities to it, when we put streets, when we put sewers, all along the way we're adding is as soon as we put amenities in, if we build a clubhouse, we put some landscape in, every single step you're increasing and forcing the value. There's not quite as many options in large scale multifamily. So that's one of the things that I really like that I wanted to mention too.
Mm-hmm. Nice. Okay. Right on. Let's kind of shift gears into round 3. And I think in a sense, we're already doing a bit of that, but I really want to dig in deeper into some of the nuances of each of these deals. Maybe Ruben will kind of hang with you, but you touched on one of the big selling points being the flexibility and the number of exits and the ability to force the appreciation. What about on the taxes and depreciation side? Are they comparable to, say, a multifamily deal? Or are they, obviously it depends on the stage and the valuation of the assets that are being held.
Yeah, they are very comparable. And one of the things about development, though, is you can choose an opportunity zone, which you can eliminate the entire taxes if you own the property for 10 years. So if you have a long-term strategy, that can be very powerful because you get to eliminate the taxes. And in addition, you get to benefit from all of the cost segregation and depreciation in that perspective. So I would say, if we're talking about the third round and discussing what we love about our individual asset classes, we love built to rent. Like Neil Bawa says, it's the hottest trend in all of real estate. And what's happening is a lot of people, especially since COVID, have been flooding out of office and retail, and industrial is getting harder. I see a lot and hear a lot of rumblings in self-storage. In multifamily in general, people are leaving because there's so much fierce competition. They're getting into sub niches, whether that's heavy lift or A class, or getting into student housing or senior housing or assisted living or some other form or version of multifamily, including development, whether that's building vertical buildings or subdivisions, which we also consider horizontal multifamily. We love that because the residents stay on average for 40 months instead of 18 months like they do. They pay the most of any real estate asset class and default the least of any segment. Rents are rising fast. It's recession resistant, just like multifamily. There's incredible investor sentiment. There's a shortage of housing. There's massive demand from institutional buyers that are willing to pay above and beyond excessively low cap rates to purchase these brand new buildings that will cash flow for them, that they can hold forever. There's lucrative returns for everybody involved. The residents get a backyard, privacy fence, doggy door, driveway, amenities, walking trails, clubhouse. We don't have to compete with numerous syndicators on the same property. And it's easy to follow other developers like D.R. Horton into their markets and mimic exactly what they're doing and copy their business plan. The governments are pro-growth in the places that we like to develop. So they're helping us because they want to provide affordable housing for their communities that they're growing, because they make money when the city grows. And of course, it attracts higher income tenants. And it's, once again, has on-site property management. So we love it for all those reasons. And I could definitely beat up a little bit on the small multifamily. I'm not sure if that's my place right now.
Hey, man, it's the final round. Now's the time.
All right, cool.
Ready to play. I like it.
All right. So, yeah, I did come to play because, small multifamily is where I got my start. And I'll always love it, but it is hard. It's a pain in the butt to property manage them. There's a vacancy risk with the small number of units. If somebody leaves, all of a sudden you're at 25% vacancy. It's very challenging to scale. There's limitations there. There's market concentration. So if you're investing in multiple small properties in the same area, it can become highly concentrated, which there's a lack of diversification there. There's financing complexity coming from the Wells Fargo mortgage industry. I know, because I used to have people come and say, hey, I'd like to purchase an 11th or 12th property. And we were like, no, at 10, you maxed out. You can't finance anymore. So that can be challenging. There's limited professional expertise because managing a small property may require, a lot of maintenance and tenant regulations. And if you're a little guy lacking these skills, that could lead to very costly mistakes. There's high competition, tons of people seeking to purchase this. So there's fierce competition in the fourplex market, at least in Phoenix, depending on where you're doing it. There's regulatory challenges. There's cash flow variability, property turnover. There's limited amenities. And of course, because of the rates going on right now, there's going to be a decrease in value in multifamily as the adjustable rate mortgages reset, because now people are not going to be able to afford to keep their properties, and it's going to drive the property values down. So there's my 4, 5, 6, 7, 8 jab, 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 uppercut.
Gloves off for sure.
Yeah. Hey, babes, can I get an ice pack down here?
Yeah, right. Cut me, Mick.
No, I love it. So, first of all, I'll just say I think we might have a little bit of a disconnect on when I say small multifamily, we don't do something as small as a 4-unit. We're really saying
no recourse. Yeah.
So we're more in like the 20 to 30 unit range. We want to be above the 4 and get away from that, get away from the financing of that. Even though you can get good financing if it's going to be owner occupied, that's a totally different story, doing a house hack kind of deal. But what I've actually seen as far as the competition right now, I have seen an incredible decrease in competition. Some of these properties that are actually on market, that they're listed where it doesn't make sense, we're throwing out low ball offers. We're talking 20 to 30% below market offers that a broker wouldn't even show that to their seller previously a year ago. And now they might say, hey, that seems a little low. And we just say, hey, this is where we're at. And then 2 weeks later, these brokers are coming back saying, hey, let's start up the conversation again. We are seeing an incredible, so many people have their pencils down in multifamily and are just not. And I think a lot of the institutional players are still active. But again, this smaller kind of sweet spot, we've seen such a decrease in transaction volume that's gone down, and buyers that are just that they say, hey, we hear all the headlines, multifamily is bad right now. So we are looking at, we feel like this is such a prime opportune time to continue to buy and build those broker relations. One thing that I'll say about build to rent is you have to wonder about the location of some of these. So to build a complex of 220 houses, so, Mike, Ligia, and I all live in Colorado. There's no land like that available unless you're going pretty far removed from the city, whether it's Denver, whether it's Aurora, whether it's Colorado Springs or Northern Colorado. So I wonder about you're basically building a community, and the hope is that there's going to be additional development that goes on around that. But we want to be closer. We want to be more in a metro area where we're closer to more restaurants and we're closer to schools and all those kinds of things. So we feel like we can find more accurate aggregate data based on what's already existing in some of those more core metro areas that already have the tried and true proven track record. So first of all, I want to say I love BTR. I love some of the people that I know that are in it, and I'm probably going to connect with Ruben offline about this. So I'm trying to throw some shade on him at the same time, saying, hey, I appreciate what you're doing, and I'm very interested in it. But we love the space that we're in. We understand that there are areas that are going to have sexier returns, but we know in affordable housing in B and C class units, the demand there, I cannot imagine a scenario. And I would love to hear someone bring some data that would show me that over the next decade, there's going to be a serious decrease in the demand for affordable housing. We don't see, we've seen occupancy drop from 97.5% back down to 95%, which is even higher than we always underwrite at 94%. But we just can't see the need for that. There's no way to build the product that we have. The cost of building for that, you're purchasing properties below replacement cost almost every single time. Everything that we bought is below the replacement cost. So that, I think, just in itself leads to such incredible demand. As long as you're flexible with your debt, we don't do any variable rate debt. And I think that's where multifamily, whether it's small, medium, or large scale, is in trouble right now.
Yeah.
Is with that floating rate debt. So I think if you have fixed rate debt that's flexible, you have the ability to weather any type of storm. One other thing I'd say about BTR, my question is, so yes, you have a brand new build, but you also have, if you have 220 unit property, you have 220, roofs, you have 220, HVAC components. And so, yes, they're brand new. So when you're comparing that to a mid 80s build and you've got a 40-year difference, you think you're going to have quite the window. But as that property ages, I could see that having a lot more maintenance over time with so many different variables. Yes, they're all consolidated and on the same parcel. I mean, they might be all individually parcel, but on the same plot of land. But there are so many you're not sharing components in some of those large CapEx items. So that's one item that I think as BTR ages over time, they might face some more operational inefficiencies there.
Well, there's definitely the scalability, right? Because if you have 100 units in one place, then you can have the same unit, buy it in bulk, and be able to replace in bulk, which would save some costs versus, something like a large multifamily building. That's what I would rebut, on that.
Yeah, I do think that makes sense. What about also, to Jesse's point, in the geographic location? So, you mentioned targeting opportunity zones.
Build to rent is very different in Portland than it is in Miami, than it is in Atlanta and Dallas and Louisiana and New York and California, right? So you're going to have different business models. Like I live in Phoenix. We don't do build to rent here. A lot of institutions love build to rent here because they can sit on money and deal with the city bureaucracy in a big metroplex. But we as syndicators, we need to make our limited partners cash fast. So we need to go to markets that move quickly, that get us through entitlements. And that's why we like the Southeast. We like places particularly that are high income. They've got a lot of migration coming in. Whereas, certain markets like you mentioned, like we've looked at Houston and some other places where the opportunities to do build to rent, they're way the heck outside of the city, man, until there's not going to be any population there for like 5-10 years. So that's not where we want to build. We want to build right along the suburbs of a secondary or tertiary market that's in pro-growth mode. And that's kind of what we like. But I've seen people have success in build to rent in all kinds of different markets. Like one that I would have not expected is Portland, where some guys are crushing it because rent control does not apply to brand new buildings, which I thought was very interesting. But we like our specific markets. Arizona is not someplace that we are yet. I would love to, if anybody's out here doing build to rent, I'd love to connect with you because I'd like to explore doing business here. But for now, we're in the Southeast where our team is, and we stay within a 4-hour radius of where our general builders and contractors are. So I would mention that.
Yeah, makes sense. Right on. Man, a lot of great stuff there. So let me pitch a final scenario out to you guys. So let's just say Lidge and I have $100K to invest. We can only invest in one deal. Give us your best pitch for kind of putting it in with you, Jesse, and then follow up with you, Ruben.
I would say it's the most proven asset class out there as far as showing how things react in all market cycles. If you look at 07 and 08, obviously the what we all refer back to when we're talking about downturns and what's all still fresh in our mind, multifamily performed pretty darn well through that. Rent decreases over that time period where some property values for single family homes were dropping 40-50%, maybe even more than that. Rent was dropping single digit, maybe even under 5% in that time period. So we love the resilience that the asset class holds as a whole, and we just believe in the tried and true operations of having a proven plan and being able to capitalize on that.
Nice. Ruben?
Yeah. If you invest $100,000 with us, not only are you going to make an incredible return, but you're going to have an impact on a community and build something that people love to call their home. So you're affecting the family and providing them with something that's brand new, a lot of times with technology, amenities, a place that they can grow their kids. And a lot of times you're improving the value of the entire city and neighborhoods where you're building. So it's a phenomenal impact study. But in addition, it's incredibly lucrative. Depending on which stage you want to get in, you can choose how much money you want to make based off of your risk tolerance. And it is an incredible way to, you apply the velocity of money principle, because, some people will say, I only want to, cash flow is king. I only want to get into cash flow. We have that opportunity. But if you want to increase the value of your $100,000 faster, then do it in development, because that's where you can increase appreciation and participate in that huge back-end equity spread, especially if you stay from the beginning until the end.
Walk me through, I'm curious how that plays out from beginning to end, just at a high level. So let's say I put my $100,000 in at the beginning. At some point, you're saying there's a decision point, or am I only investing in a 12-month window during the development? It's all clean. You pay me out, and then I could reinvest the $100K or something more into the next phase, or how does that kind of cascade through the project?
Yeah, well, we haven't accepted any money in the land phase, but that I would assume would be very lucrative, because as soon as you get the property entitled, you just change the value, increased it significantly. Mm-hmm. That is probably the scariest part, because you just don't know, dealing with banks or dealing with the city possibly saying no, or making you rechange your architectural plans. So if you get in at that phase, let's say that you got like a 1.5x, equity multiple in 6 months, And then another 12 months, you double that money again. And then in another 24 to 30 months, or we would say 5 years, but internally we believe we can do it in 24 to 30 months. Then you also get another doubling of your money. So you take $100,000 and in 5 years, you almost triple it or quadruple it. So it's very powerful if you're staying from the very beginning, although we're not yet offering investors to come in at that land phase.
Sure.
I guess at some point we'll need to, if we really want to build 10,000 units in the next 10 years, we're going to have to get a fund going, and we're going to have to do some variety of creative structures to bring people in either at multiple phases or have one hybrid fund that allows people to invest in all portions of it and possibly in multiple deals to diversify the risk.
Mm-hmm. Yeah, but regardless if I get in at the land phase or after entitlements or whatever, am I investing end to end in the deal, and you're just paying me out? Like, okay, the money doubles and you're giving me a payout, but my 100K is still in the deal, or am I re-signing in on development phase 3? Or
yeah, so it depends on a deal by deal. You can come in as a JV, you can come in as a co-GP, which is my preferable route of partnering with people.
Mm-hmm.
And then, of course, you're going to make more money based off of bringing in capital and partnering and managing and getting paid for duties that you participate in, whether that's management or construction or all of that good stuff, right? So you're also participating in fees. But the big payday is at the end when you sell your project. So I think if you start at the beginning and go until the very end, that's going to be the maximum return that you could make, but you're going to have to deal with all of the different levels of risk and all of the anomalies that happen on each individual development project, right? Because like a wetland survey can happen, and all of a sudden, like you have to do land grading, or rain can come and slow down your process. There's all these things that you have to deal with and be flexible in that kind of project. But every single building in your city downtown was syndicated and somebody built it, and now people are rebuying it. So I think the idea here with development is you have to find a sponsor that knows what they're doing, that can mitigate all of your risk and be a good steward of your capital. Because there's a lot of new rookie developers, people that dabble in single family or maybe build 10 houses or a couple fourplexes at a time, and they're doing it for the first time. That's super scary. I would definitely, if you're going to partner with the syndicator, or if you're going to get into syndication, partner with somebody who's done it before. If you want to launch a fund, instead of dealing with the objection of how many of these funds have you done, partner with the fund manager who's already done it before. And if you want to get into development, don't do it yourself. Like, partner with somebody that's already developed. In all three of those cases, you want to partner with an operator or somebody that can walk you through the process that's already done it before.
Yeah, amen to that.
Yeah, I guess one thing, thinking as a passive investor myself, I just and not to jump back into round 3, but I think some of the differences is, as a non-seasoned investor, I feel like there's so many more variables that you have to almost hold your breath over,
for sure,
to just or get used to. And I agree that having a good sponsor with really effective communication, which is always key. But I feel like even more so with that, to understand, okay, so we're not cash flowing, which we knew going in, but like, what the heck is going on, and what does this mean? Are there setbacks, or all these kind of variables that with
for sure,
in general, it's kind of more just to, show me the monthly or the quarterly reporting. Let me know how things are, it's just, there's a lot of ease of mind if that's something that's important.
And absolutely. And Jesse, I'll even throw you a bone here, because you know what people really love about multifamily is that it's very easy to understand.
Yep.
Right? You buy a property, you take really good care of the property, you fix it, you get better tenants or improve the quality of living, you increase the net operating income, you lower efficiencies. I think people can understand that very easily. But as soon as you start talking about like surveys and entitlements and construction costs changing, it adds all these variables that people really just, they want to grasp, and they can kind of get the idea that it's a super incredible trend, but they're still resistant to invest because they don't understand it as easily as they do multifamily. So that's why I think multifamily is so sexy. So, I mean, if I was diversifying my money into multiple asset classes, multifamily would be one place that I parked it, as long as it was a long-term strategy, at least in today's environment. Not necessarily, because there's guys like Zach Kappenstall that are crushing it very quickly. But I like multifamily. I like development. I like short-term rentals. I like self-storage. I like medical office buildings. I like oil and gas for tax benefits. So, you want to have some money in as much diversification as you feel comfortable with, but some high risk, high return money in development, I think, is a good bet, depending on your financial situation. So check with your counsel and attorney and advisors.
And then just roll all your earnings, whatever asset class you go into crypto and just pray for the best.
Woo!
Right on. All right, guys. Well, that was an awesome matchup. Thanks both for sharing the ins and outs of your business models. A lot of great stuff there. I found it very informative and inspiring. Throughout the matchup, we've been watching for some key factors, like how many resources does it need to get going, risk and reward, as we just talked about, your level of enthusiasm to crown the champion. So we're going to take a hot minute here just to compare notes, and we'll come back with a decision. All right, guys. Honestly, this was is a pretty close matchup. Beautiful business models. Ruben, I echo all of your sentiments about the different asset classes you mentioned, and encourage any and everybody to really diversify, even within real estate, right? To get into different asset classes and stuff like that. But we say on the Cash Flow Fight Club podcast that we truly believe there are no losers, but we do have to pick a winner. So we conferred with each other. We had a little bit of a split decision here, so we had to kind of duke it out as husband and wife. But
who's the third party, the arbitrator?
The contract.
Right? But for this matchup, we're going to go with Build to Rent and Ruben as the champion. It's definitely, I would say, a riskier play, but I love the flexibility and the potential for upside in terms of getting in and getting through. But man, we love multifamily too. Obviously, we're kind of deeply in it.
Yeah,
we love multifamily too.
Hey, great job, Ruben. It was awesome to go up on a matchup against you. I was hoping for an easier opponent, but man, they threw me into the title.
I would say you came to play, buddy. I like it. So
it's hard to battle against multifamily in general. It's like the most resistant asset class in existence. So
it is, yeah. Built to Rent's really coming on strong, though. I love that as an option for a lot of people that don't necessarily want to be in an apartment but can't quite get into a house. So where it works, that's a great one. But anyway, as they say in the fight business, and we say it here on the Cash Flow Fight Club podcast, and it's also big in real estate, it is a team sport. We talked about partnerships. I'd love to do a whole episode on picking partners and vetting sponsors.
Yeah.
And that's super critical for investors. But we like to end our shows with a little bit of gratitude. And so anybody in particular that you want to shout out to, Ruben, that's been instrumental along your way, and then we'll pivot over to Jesse.
I read a quote at my team meeting today from Wayne Dyer, and it said, if you're going to say only one prayer every day, let it be thank you. And I think I'm just a huge fan of these spiritual gurus, not only like Wayne Dyer, but like I also consider Napoleon Hill and Wallace D. Wattles, these guys that talk about thinking and growing rich, to be very spiritual, especially when they start talking about like auto suggestion and subconscious. It's like what they do is just very powerful. So I'd give a shout out to all of those mentors that talk about mindset that have really helped me along the way. Wallace D. Wattles, Wayne Dyer, and Napoleon Hill.
Beautiful. Like it. Mr. Dickens?
Yeah. And I love that you do that you wrap it up with gratitude. And I agree that, looking at trying to live by the principle of gratitude at the forefront in all of your endeavors is really the best way to maximize value in your life as well as the people around you. I would say to my mentors, Jake Stenziano and Gino Barbaro, for getting me on the path of multifamily. And then for my two main partners in Wealthcare Capital Partners, husband and wife, Christian and Joy Yee. who have been an absolute blessing to work with, and hope that we have a long and fruitful journey together. So, yeah. And you
Jake
guys,
and Gina are amazing. Yeah.
and then
you
Mike and
guys-
Lydia, of course.
This is a really cool format, guys. Props
Yeah.
for
Yeah,
creating
thanks.
it.
Yeah, we love it.
We are so
A
grateful.
little stressful. Like I was kind of like nervous coming into I've never been so anticipatory of a podcast before this one. I'm just like, oh my God, I got a battle.
Awesome. I love that. That's great.
You guys had a great match. You really got into it. I love it. So thank you so much for coming on the show, both of you, and for sharing your insights and expertise. And for the listeners that were inspired to listen and to find out more of what you do, what's the best way to find you, to get in touch with you? Jesse.
Sure. Reach out directly. I'll leave my cell phone number on here because I always love talking real estate, just talking about life in general, talking about medicine, whatever it is. 720-229-9899. You can email me, jesse@wealthcarecap.com. You can check out our website, wealthcarecap.com, on social media, Facebook, LinkedIn. But yeah, reaching out directly is the best way, and I'd love to connect.
That's bold, man.
Thanks.
You'll get the call from our one listener who's my mother. So thanks.
How about you, Ruben?
So if you just want to hang out and talk shop, LinkedIn is a great place. If you're interested in capital raising, we got this show called The Capital Raisers Show. You can tune in on your favorite platform. Or if you're interested in the build to rent stuff, you can check us out at legacyacquisitions.com.
Awesome. We'll get all that in the show notes. And again, we're also grateful. I'll just echo what Lydia said, for you guys both spend a little time with us, sharing some insights, and most importantly, really helping people invest more wisely with their money and find their way to financial and lifestyle freedom. That's what we're all about. So for those of you tuning in, thank you again for so much for investing your time with us while we were here on the Cash Flow Fight Club podcast. We certainly had a blast. We learned something new, and we hope you did too. If you did have fun, please subscribe to the show and get more great matchups coming down the pike. So Jesse, Ruben, thanks again. Everybody else, have a great day. For those of you tuning in, we thank you so much for investing your time with us on the Cash Flow Fight Club podcast. We certainly had a blast, received some knockout insights, all while learning something new. And we hope you did too.
If you had fun, please subscribe to the podcast wherever you watch or listen.
Lydia and I truly believe the beauty of cash flow is having your money fight for you instead of you having to fight for money. So whether it's one of these methods or something else, we encourage you to dream big and take action. See you next time.